Disappearing fortune. More than 11,000 people believed they had found a safe investment. Teachers, engineers, retirees, families saving for the future. They were promised stable returns, backed by real businesses and real assets. Instead, £237 million. And for years, no one seemed able to explain exactly where the money had gone. The company behind the scheme was called London Capital and Finance. On paper, it looked like a legitimate investment firm operating within the UK's financial system. It advertised widely online, it carried the credibility of regulatory approval, and it promised returns far higher than traditional savings accounts. But behind the polished marketing and professional image was something far darker. New investors' money was quietly paying returns to earlier investors. Millions were being diverted into companies linked to the people running the operation. Luxury properties were bought, supercars were driven, helicopters were flown, all while ordinary people unknowingly funded the lifestyle. By the time the scheme collapsed in 2019, it had become what many investigators now call Britain's biggest retail Ponzi scheme. But the most unsettling question remains: how did a company operating in plain sight take hundreds of millions from ordinary investors and keep doing it for years? To understand that, we have to start with the promise that began it all. The promise: a safe investment. London Capital and Finance, often called LCF, was founded around 2012. The company offered investors something called mini bonds. Mini bonds are essentially loans. Investors lend money to a company in exchange for fixed interest payments over a set period. LCF marketed these bonds as a way to fund small and medium-sized British businesses. Investors were told their money would help businesses grow while generating steady returns. Those returns ranged from 6.5% to 11% per year, far higher than bank savings accounts. For many people, the offer seemed attractive but believable. Interest rates were extremely low across the financial system. Retirees in particular were searching for ways to make their savings work harder. LCF's bonds appeared to provide exactly that. The company's website looked professional. Advertisements appeared on Google and Facebook. Some promotions even suggested the investments were suitable for ISA-style savings, creating the impression of tax-efficient, secure returns. And perhaps most importantly, London Capital and Finance itself was authorized by the Financial Conduct Authority, the UK's financial regulator. That single detail gave the entire operation a halo of legitimacy. But there was one crucial detail that many investors did not fully understand. While the company was regulated in some respects, the mini-bonds themselves were not regulated investment products. That difference would later prove devastating, because behind the scenes, the money was not being used the way investors believed. Every financial scandal eventually comes down to people, and in the case of London Capital and Finance, a small network of individuals controlled almost everything. At the center was Spencer Golding. Golding was widely described as the real power behind the operation. He had previously been involved in timeshare businesses and property deals. His background included earlier director bans related to business activities. Despite not always appearing formally in leadership roles, court findings later suggested he exercised enormous influence over the company. Alongside him was Michael Andy Thompson, the official chief executive of LCF. Thompson was the public face of the company. He appeared as the executive, overseeing its bond offerings and corporate structure. Another key figure was Simon Hume Kendall. Unlike some of the others, Hume Kendall brought an air of establishment credibility. He had social connections, political involvement, and a background that helped present the company as respectable. Then there was Paul Careless, a former police officer who had reinvented himself as a digital marketing entrepreneur. His company, Surge Financial, became the engine that brought investors into the scheme. And finally, John Russell Murphy, a salesman who dealt directly with many investors and helped close high-value deals. Together, these figures formed a network that blended marketing, credibility, corporate control, and aggressive sales. Each played a different role in expanding the operation. But to understand the scandal, we need to look at how the system actually worked. To investors, the process seemed straightforward. They purchased LCF mini bonds, expecting their money to be lent to businesses that would generate profits and repay the loans with interest. But the High Court later found that the majority of those loans were not going to independent businesses at all. Instead, large portions of investor money were funneled into companies linked to the same small group of insiders. These companies often had little genuine commercial activity. In many cases, money flowed into them and quickly flowed back out again. Meanwhile, LCF continued paying interest to earlier investors, creating the illusion that the investments were performing exactly as promised. But the source of those payments was not profitable business ventures. It was new investor money. This structure meant the entire system depended on a constant inflow of fresh investment. As long as new investors kept arriving, the company could continue paying interest and maintain the appearance of success. But if new investment slowed down, the entire structure would collapse. This is the classic pattern of a Ponzi scheme. And yet the operation continued expanding. Because the marketing machine behind it was extraordinarily effective. One of the most striking aspects of the LCF scandal was how aggressively it used digital marketing. The company appeared frequently in online advertisements. Search for high-interest savings products, and you might see London Capital and Finance promoted alongside legitimate financial offerings. Behind much of this strategy was Paul Careless and his marketing firm, Surge Financial. Surge specialized in generating online leads, potential customers searching for financial products. Through advertising campaigns, price comparison-style websites, and targeted marketing funnels, investors were directed toward LCF's bond offerings. The commissions paid to Surge were enormous. Evidence later presented in court suggested that as much as 25% of investor money could go toward marketing commissions. Think about what that means. For every £10,000 invested, roughly £2,500 could disappear immediately in marketing costs. That alone made the promised returns extremely difficult to sustain. Yet the marketing continued. Because the scheme required a steady stream of new investors, and for several years, it succeeded. So what actually happened to the £237 million investors handed over? Court investigations and administrator reports painted a picture of widespread diversion of funds. Large sums were directed into companies linked to the insiders running the scheme. Some money went toward property developments and business ventures connected to those same individuals. But a substantial portion appeared to fund luxury lifestyles. Luxury properties were purchased. Equestrian estates and horses were bought. Supercars and high-end vehicles appeared in the lives of those connected to the operation. There were watches, jewelry, expensive travel, and exclusive memberships. In some cases, assets were later seized or sold during bankruptcy proceedings. But by the time administrators began trying to recover funds, much of the money had already been spent or transferred through complex company structures. For the people who had invested their savings, the discovery was devastating. And for many of them, the consequences were life-changing. Behind the financial numbers were thousands of ordinary people. Many of them had invested retirement savings. Some had moved money out of traditional bank accounts because the interest rates there had fallen so low. They believed they were making a sensible financial decision. Instead, their savings disappeared. Victims reported losing homes, retirement plans, and financial security. Some described years of stress and anxiety as they struggled to understand what had happened. Campaign groups formed as investors tried to push regulators and the government to take responsibility. One victim, an engineer named Ian Davis, spent years trying to track where the money had gone. Friends later said the financial loss devastated him. He eventually took his own life. Stories like this turned the LCF collapse from a financial scandal into a national controversy, because it raised a troubling question. Where were the regulators while this was happening? The UK's financial regulator, the Financial Conduct Authority, had received warnings about London, Capital, and Finance years before the company collapsed. Some financial advisors had raised concerns about the structure of the bonds and the connections between companies involved. Members of the public had also contacted the regulator. Yet, meaningful intervention came late. In 2020, an independent investigation, known as the Gloucester Report, examined the FCA's actions. Its findings were deeply critical. The report described serious failures in how the regulator handled the warnings surrounding LCF. Investigators concluded the FCA had missed opportunities to intervene earlier and prevent further investor losses. Part of the problem lay in the regulatory boundaries. Many bonds themselves were technically outside the FCA's core regulatory perimeter, but the marketing of those bonds was regulated, and the report concluded that the watchdog had not used its powers effectively. For victims, this added another layer of anger. Because the scheme had operated for years under the appearance of regulatory credibility. In December 2018, the FCA finally stepped in. The regulator ordered London Capital and Finance to withdraw its promotional materials and stop certain activities. Within weeks, the company entered administration. The collapse revealed the scale of the problem. More than 11,600 investors were affected. Hundreds of millions of pounds were missing. Investigators began examining the company's records. eventually reviewing millions of documents to trace the money. But the collapse was only the beginning of a long legal battle, because the question of accountability was far from resolved. In March 2019, the Serious Fraud Office launched a criminal investigation into London Capital and Finance. Several individuals connected to the scheme were arrested that year, but investigations of complex financial fraud often move slowly. Years passed without criminal charges. Meanwhile, administrators working on behalf of investors began pursuing civil cases against those involved. These cases aimed to establish liability and recover assets wherever possible. The legal process would eventually produce one of the most significant rulings in the entire scandal. In November 2024, the High Court delivered a landmark decision. After a lengthy civil trial, Mr. Justice Miles ruled that London Capital and Finance had indeed operated as a Ponzi scheme. The judgment described systematic misrepresentation and fraudulent trading. Several key individuals were found liable for breaches of duty or dishonest assistance in the scheme. Civil damages, running into hundreds of millions of pounds, were ordered. But the court also recognized a difficult reality. Much of the money had already been spent. Recovering it in full would likely be impossible. In response to the scandal, the UK government introduced a compensation scheme for many affected investors. £115 million was eventually paid out through the scheme. For some victims, this provided partial relief, but many investors had lost far more than the compensation limits allowed. Administrators continued selling assets linked to the scheme: properties, horses, vehicles, and other luxury items. Yet, even with those recoveries, a large portion of the original £237 million is unlikely ever to be returned. Years after the collapse, the individuals involved face varying consequences. Some have declared bankruptcy. Assets connected to them have been sold. Civil liability has been established through the courts, but the criminal investigation remains ongoing. For many victims, the absence of criminal convictions continues to be a source of frustration, because from their perspective, the damage done by the scheme was undeniable. The London Capital and Finance scandal is more than a story about financial fraud. It is a story about how credibility can be manufactured, how professional branding and regulatory appearances can create trust where none should exist, and how ordinary people acting carefully, not recklessly, can still be drawn into catastrophic financial traps. More than 11,000 investors believed they were making a safe choice. Instead, they became part of Britain's largest retail Ponzi scheme. And even now, years later, the question that began the story still echoes. Out of the £237 million entrusted to London Capital and Finance, how much will ever truly come back?